They never talk about the nights the vault doors move. Not in the public tours, not in the polished statements, not in the ceremonial photos where gold bars gleam under perfect lighting. Those are for the history books. The real story unfolds in the dark beneath the humming concrete of central banks when a single decision in a quiet room forces the world's oldest asset to play a role it was never meant to display openly. Most people think of gold as dead weight beautiful, symbolic, a relic of past centuries. But the truth is far more active and far more dangerous. Gold still breathes inside the modern financial system, and when markets tighten, it stops being an ornament and becomes something else entirely. It becomes collateral, a lifeline, a backdoor. In these critical moments, gold doesn't move because traders are speculating or because headlines are screaming about panic. It moves because two central banks whisper to each other across oceans, agreeing silently that one will temporarily surrender a piece of its sovereignty to secure liquidity that no one can ever know it needs. This is the hidden world of gold swaps. These are transactions that never trend on financial media, never appear on breaking news banners, and certainly never fit the official narrative that central banks are stable, independent, unquestionable pillars of confidence. A gold swap is the moment the facade cracks. It's when a central bank admits quietly and completely off the record that it needs dollars, euros, or some other form of emergency liquidity so urgently that it's willing to hand over a portion of its national treasure as collateral. Think about that for a second. An institution that can literally print its own currency is forced to use an asset it cannot create to borrow money from another institution. That's not a sign of strength. It's a quiet signal of desperation. But the public never sees this desperation. We only see the aftermath, buried deep within balance sheet notes, vague footnotes, or unexplained line items in quarterly reports. You might see a line that says gold and gold receivables, and that innocuous word receivables is the only clue. It's the trace left behind. And yet, if you watch these reports long enough, you can feel the shift. You can sense that a subtle change in reported reserves hints that something significant happened behind the curtain, something that wasn't meant to be seen. Gold becomes the one asset that speaks without speaking, revealing a level of stress the system refuses to name out loud. So why does this happen? To understand gold swaps, you first have to understand the fundamental tension at the heart of our modern monetary system. Central banks project an image of absolute control. They set interest rates, they manage inflation, they're the lenders of last resort. Their credibility is everything. The entire system is built on the belief that they will always have the situation under control. But what happens when they don't? What happens when a country faces a sudden, catastrophic currency crisis, or its banking system is on the verge of collapse and it desperately needs access to foreign currency, like US dollars, to stabilize itself? Going to the International Monetary Fund, the IMF, is one option. But that's a very public process. It comes with strings attached, with politically difficult austerity measures, and most importantly, it's a public admission of failure. It signals to the world that your country is in deep trouble. No government wants that headline. So they look for another way, a quieter way, a backdoor. This is where gold comes in. A central bank can approach another central bank, say, the Federal Reserve in the US or the Bundesbank in Germany, and propose a swap. It works like this. Central Bank A gives a portion of its physical gold to Central Bank B. In return, Central Bank B provides the needed currency, let's say dollars. This isn't a sale, it's a collateralized loan. The deal includes an agreement to reverse the transaction at a later date at a predetermined price. Central Bank A gets its gold back, and Central Bank B gets its dollars back, plus a small amount of interest. The beauty of this arrangement, from their perspective, is its secrecy. For accounting purposes, the central bank lending its gold can often keep the gold on its balance sheet. It's simply reclassified. Instead of gold, it might be listed as gold receivables, as we mentioned. To the untrained eye, nothing looks out of place. The country's total reserves might not even appear to change. It's the perfect way to get emergency cash without spooking the markets or admitting weakness. The most famous modern example of this involves the Bank for International Settlements, or the BIS. The BIS is often called the central bank for central banks. It's a highly secretive institution based in Switzerland, and it acts as a trusted intermediary for these kinds of sensitive transactions. In the aftermath of the 2008 financial crisis, and during the European sovereign debt crisis that followed, the BIS's balance sheet showed a massive unexplained spike in gold swaps. It jumped from virtually zero to hundreds of tons. The BIS never officially disclosed who was involved. They never said which central banks were so desperate for liquidity that they were secretly pawning their gold. But analysts pieced together the clues. The timing strongly suggested that struggling European commercial banks, and possibly even some central banks, were using their gold to get the dollars they desperately needed to stay afloat. The official story was one of bailouts and rescue packages. The unofficial story, the one written in the language of gold swaps, was one of quiet desperation and backroom deals to hold the system together. Imagine the conversations that precede a vault opening at 2 a.m. Imagine the pressure that forces a finance minister or a central bank governor to make that call. These swaps are not about making a profit. They are about survival. They're about maintaining the illusion of stability while the machinery underneath is straining, groaning, and threatening to break. When gold leaves a vault, even temporarily, it is never a small story. It is a signal. It's a confession. It's a warning. And yet, the world is conditioned to read it as nothing. We're told that gold is a barbarous relic, that it has no real role in modern finance. But if that's true, why is it the ultimate collateral when the system is under extreme duress? Why is it the one asset trusted between institutions that otherwise might not trust each other as paper promises? The truth is, gold is the system's silent arbiter. It's the asset that exists outside the promises of governments and central banks. You can't print it, and you can't devalue it with a keystroke. Its value is recognized globally without question. That's why, in a true crisis, it becomes the ultimate form of trust. When a central bank gives another central bank its gold, it's not just handing over a shiny metal. It's handing over a piece of its sovereignty as a promise that it will make good on its debt. This brings us to the present day. We live in a world of unprecedented debt, geopolitical tension, and a fragile global financial system. Central banks around the world are now buying gold at a record pace. Why? The public narrative is diversification, but the real reason might be far more pragmatic. They are restocking their emergency toolkit. They are preparing for a future where they might need that ultimate, off-the-books collateral once again. When you see a country repatriating its gold, bringing it home from vaults in London or New York, it's not just a symbolic act. It's about control. It is about ensuring that if they ever need to use that gold in a swap or as collateral, it is physically within their grasp, ready to be deployed at a moment's notice without needing permission from anyone else. So the next time you hear about a financial crisis, or you see a country's currency start to wobble, don't just watch the headlines. Look deeper. Look at the footnotes in the central bank reports. Look for subtle changes in the gold reserve data. Because the real story of financial stress isn't always yelled from the rooftops. Sometimes it's whispered in the silent, invisible movement of gold between vaults. This isn't a conspiracy theory. It's just the hidden mechanics of the global financial system. It has a backdoor that has to exist because the official front door, the one that projects confidence and stability, can always handle the pressure. Gold is the key to that backdoor. Understanding its role as ultimate collateral changes how you see everything, every crisis, every reserve number, every silent shift in global power. For decades, we've been told gold is a relic, a shiny, primitive asset left behind when money evolved into paper backed by confidence. Central banks, we heard, no longer needed vaults full of bullion because modern finance had moved on. But history tells a very different story, one hidden just beneath the surface of official narratives. It's a story of secret maneuvers, quiet agreements, and the one asset that central banks turn to when the world isn't watching. To understand why gold is the ultimate collateral, we have to go back to a time when currencies lived and died by what sat in national vaults. Before World War I, the bond between gold and money was almost sacred. A nation's currency was a direct reflection of its gold reserves, and the promise to convert paper back to metal was absolute. But even then, in the shadows of official policy, an emergency tool existed: the gold swap. These weren't common, never discussed, and certainly not advertised. But when a government needed cash faster than markets could provide it, these swaps surfaced. The idea was simple. One central bank would lend gold, or accept it as security for a short-term credit line, allowing another to fix a temporary funding gap without sounding the alarm. These early swaps set the stage for a century of discreet coordination, where gold became the secret language of central banks, a way to communicate and cooperate when they couldn't afford to look weak. As global finance grew, gold's role didn't shrink. It just went underground. The chaotic years between the two world wars only deepened its secret importance. The gold exchange standard was cracking. Britain was struggling to hold the value of the pound, while France was hoarding gold like a dragon. To prevent a total collapse, central banks started a series of desperate, behind-the-scenes maneuvers. Gold loans, gold-backed credits, and unofficial swaps became the lifeblood of Europe's monetary system. You wouldn't read about these deals in the newspapers because admitting to them would be admitting the entire system was fragile. But behind closed doors, gold was no longer just a rigid backing for money. It had become a flexible tool for survival. When one country's reserves were draining away, another could step in, accepting gold as collateral to provide a lifeline. These weren't the actions of confident institutions. They were the actions of guardians frantically trying to keep a crumbling monetary order from falling apart. After World War II, the Bretton Woods system created a new world order for currencies, but it didn't get rid of the shadow mechanics that had evolved. The US dollar, backed by gold, became the anchor of the global economy. Europe and Japan rebuilt their economies under America's financial protection. But even within this seemingly stable structure, gold swaps were quietly used by countries that needed dollars but couldn't afford to broadcast their shortages. But below the surface, it was defined by constant tension dollar shortages, capital flight, and pressure on fixed exchange rates. When countries faced a run on their currency, they often turned to gold, not to settle their debts for good, but as collateral for emergency dollar support. European central banks engaged in swaps with the U.S. Federal Reserve, the Bank for International Settlements, and each other. It was an elegant solution. A short-term, gold-backed loan didn't look like a humiliating bailout request. The gold moved silently, its transfer hidden in obscure technical notes. The public saw only the calm, reassuring faces of central bankers insisting everything was perfectly under control. By the late 1960s, the strain was becoming too much to bear. The U.S. was facing a steady drain on its gold reserves as foreign governments, especially France, demanded that their dollars be converted into actual bullion. History books focus on President Nixon closing the gold window in 1971, but they rarely mention the secret operations that came before it, operations designed to buy time and hide the system's deep-seated weaknesses. One of these was the London Gold Pool, an arrangement where several central banks worked together, selling gold to keep the price fixed at $35 an ounce. This entire scheme depended on coordinated gold mobilization. When one of the participating countries faced its own financial pressures, It would engage in quiet swaps to meet its obligations without revealing how dire its situation really was. The whole system survived on secrecy, coordination, and improvisation, a hidden financial architecture built to preserve confidence at any cost. When the London gold pool finally collapsed in 1968, gold officially lost its fixed price, but it did not lose its function. Instead, it moved even deeper into the shadows. With currencies now floating freely and financial markets globalizing at incredible speed, central banks needed even more flexible tools to manage crises. The dollar was king, but gold remained the only true outside asset, one that could be moved across borders without relying on another country's legal or financial system. Throughout the oil shocks, inflation spirals, and debt crises of the 1970s and 80s, gold swaps reappeared whenever a country faced a sudden funding crisis. Italy, Portugal, and others quietly used their gold reserves to secure foreign currency loans, often through the Bank for International Settlements, to avoid public panic. These deals were never announced to voters or investors. They were designed to project strength while privately acknowledging weakness. Gold moved discreetly between vaults in London, Basel, and New York, its journey disguised in financial reports with vague terms like gold receivables or gold under swap, phrases that concealed far more than they revealed. Then, as financial markets continued to evolve, a new player entered the game: the bullion banks. Their arrival added another layer of complexity and secrecy. Now, central banks could swap gold not just with each other, but through powerful intermediaries that specialized in turning metal into cash. These bullion banks acted like shadow conduits, allowing transactions to happen completely out of the public eye. Imagine a country facing sudden political instability. Capital is fleeing, and its bond markets are in turmoil. It needs dollars, and it needs them now. That country's central bank could discreetly transfer some of its gold to a bullion bank, receive cash in return, and then, once the crisis passed, quietly unwind the swap. To the outside world, nothing would look amiss. Official reserve numbers would remain largely unchanged, and the central bank could confidently state that no major emergency had occurred. The entire system survived on secrecy, coordination, and improvisation, an underworld architecture built around preserving confidence at all costs. When the London gold pool collapsed in 1968, the world thought gold's official role was over. It was no longer pegged to a fixed price. But instead of fading into history, gold just stepped deeper into the shadows, becoming a secret weapon for central banks. As currencies began to float freely and financial markets went global, central banks needed new, flexible ways to handle crises. The U.S. dollar became the king of reserve currencies, but gold held a unique power. It was the only asset that could be moved across borders without relying on another country's legal system or banks. Think about that. Its pure, untethered value. This secret power was put to the test in the 1970s and 80s. Oil shocks, runaway inflation, and sovereign debt crises were shaking the global economy. When countries like Italy and Portugal suddenly needed cash, they didn't panic publicly. Instead, they quietly used their gold. Through secret arrangements, often managed by the Bank for International Settlements, or BIS, they swapped their gold for foreign currency loans. These weren't deals you'd read about in the newspaper. They were designed to project an image of strength to the public while privately admitting they needed help. Gold bars were discreetly moved between vaults in London, Basel, and New York. On the official books, these transactions were hidden in plain sight, disguised with technical jargon like gold receivables or gold under swap. These phrases were designed to confuse, not clarify. The goal was to keep markets calm and prevent a public panic. Secrecy was everything. Then, as the financial world evolved, a new player entered the game: bullion banks. These specialized institutions added another layer of complexity and secrecy. Now, a central bank didn't have to swap gold directly with another central bank. They could go through a bullion bank as an intermediary. Imagine this. A country is facing political turmoil and investors are pulling their money out fast. The central bank needs dollars and it needs them now. But the bond markets are hostile. What do? They can quietly transfer some of their gold to a bullion bank, get the cash they need, and then, when the crisis passes, reverse the transaction. To the outside world, everything looks normal. The country's official reserves barely seem to change on paper. The central bank can confidently say there was no major emergency. This entire shadow system worked because it was invisible. By the 1990s and early 2000s, the financial world was transformed by derivatives and global interconnectedness. And gold swaps evolved right along with it. They were no longer just for emergencies. They became a sophisticated tool for hedging, for boosting liquidity, and even for obscuring the true state of a central bank's finances. Some use swaps to manage the price risk of their own gold holdings. Others use them to secretly prop up their currency. A few even use them to hide financial weakness from the world. Then came the 2008 global financial crisis. The entire system froze. Liquidity vanished, and even the biggest banks in the world were desperate for dollars. The headlines were all about the massive swap lines opened by the U.S. Federal Reserve to help other central banks. But behind the curtain, another, much older system was at work. Later reports revealed that during the peak of the crisis, the use of gold swaps and leases quietly surged. The logic was the same as it had been for decades. When confidence collapses and no one is willing to lend, gold becomes the ultimate collateral. But unlike the publicly announced Fed swap lines, these gold transactions required no press conference, no political approval, and no public justification. They just happened, recorded in obscure lines on financial statements that only a handful of experts could ever decipher. In the years that followed 2008, gold's shadow role didn't shrink. It deepened. New international banking rules, known as Basel III, officially recognized gold as a top-tier liquid asset. This gave it an official stamp of approval as high-quality collateral, making it even more attractive for these secret transactions. Emerging market central banks took notice. They started accumulating gold not just as a symbol of national wealth, but as a practical tool for survival. They understood that in a real crisis, gold could be their lifeline to get the dollars or euros they needed, especially if they were cut off from traditional lending by sanctions or geopolitical tensions. We see the headlines about countries like China and Russia buying tons of gold. But what we don't see are the backdoor deals that make those reserves functional when a crisis hits. And so, when the 2020 pandemic sent shockwaves through the global economy, this hidden architecture was ready. Central banks threw everything they had at the problem. We saw them print trillions of dollars and expand their balance sheets to unprecedented levels. But once again, we didn't see the silent movement of gold behind the scenes, providing liquidity where the official system was cracking under the strain. History was repeating itself. Every time the system is pushed to its breaking point, gold quietly steps out of its ceremonial showcase and into its real functional role. With each new crisis, the methods become more sophisticated, the transactions more discreet, and the reliance on gold more essential to maintaining the illusion of stability. This is the hidden history that defines our modern financial system. It's a story of silent agreements, secret transfers, and emergency backstops that no official will ever openly admit to using. It's why gold, despite being declared a relic of the past over and over again, remains the ultimate form of collateral. It's the asset you turn to when everything else begins to break. They tell you modern central banking is a clean, logical machine. Every move is deliberate, transparent, and based on solid policy. But what if I told you there's a hidden signal, a tell, that shows when this pristine facade cracks? A moment when the world's most powerful financial institutions start acting like desperate borrowers. This moment isn't in a press conference or a policy report. It's buried in a footnote, a single line most people will never see. Gold under swap. This isn't a routine operation. It's the system's silent fire alarm, the one they hope nobody hears. When you see this line on a balance sheet, it means the central bank has decided that the risk of public embarrassment and political fallout is better than doing nothing. The real twist? By the time a gold swap appears, even hidden in technical jargon, the crisis is already far more advanced than anyone imagines. It's an admission that all other options have been exhausted. Think about what has to happen before this point. Traditional funding channels have tightened. The all-important dollar markets have become selective, only lending to the safest borrowers. Bond investors have vanished. Foreign exchange reserves are running low. Commercial banks, the lifeblood of the system, are hoarding liquidity for themselves. The entire financial network has shifted into self-preservation mode. A gold swap isn't the start of the problem. It's the final, quiet confession that the game is almost over. And this is where the story gets really unsettling. Why gold? Central bankers don't suddenly believe in its ancient, mystical power. They turn to gold because it's the only asset that doesn't require trust. A dollar swap? You need the Federal Reserve's blessing. A new bond issuance? You need buyers in the market. And I am flown? That means painful political negotiations and public scrutiny. But gold? Gold is different. Gold just requires movement. It doesn't negotiate. It doesn't ask questions. It can't be frozen by sanctions or withheld by an unfriendly government. It's the ultimate neutral collateral, the final mechanism available when a central bank needs liquidity and absolutely cannot let the world know that its liquidity has vanished. It's the escape hatch when all the normal doors have been locked from the outside. But the story gets darker still. Sometimes, these gold swaps happen before the crisis even becomes visible to the public. You and I see stable markets, calm exchange rates, and confident policy statements. But behind the scenes, central bankers are feeling the pressure. They see the daily funding stress, the widening spreads on their debt, the quiet refusal of other banks to do business. They hear the silence in markets that were once overflowing with cash. And in that silence, they recognize the early tremors of a financial earthquake. So, what do? To avoid the public humiliation of a bailout or a currency collapse, they mobilize their gold. Not as a reaction to a crisis, but as a preemptive defense against one. This is the part the economics textbooks never mention. Gold becomes collateral not just asterisk in asterisk a crisis, but asterisk before asterisk one, when central bankers sense a shift long before anyone else. They swap their gold to secure liquidity they might not need today, but they know they'll desperately need tomorrow. They are preparing for a hurricane while telling the world it's just a lovely day for a picnic. And here's the final, crucial twist. The act of swapping gold, even just once, changes everything. It creates a precedent. It crosses a psychological line that a central bank can now cross again and again. Once a central bank accepts that its gold can be used as a hidden backstop, it never goes back to the old world where gold just sits in a vault gathering dust. From that moment on, gold becomes a live, strategic instrument. It can be a bargaining chip in secret negotiations. It can be a silent warning to speculators. It's a hidden shield against market disbelief. When volatility spikes, when foreign investors pull their money out, when the currency markets turn hostile, the central bank now knows it has an option the public doesn't even know exists. And if the markets were really paying attention, they would understand the terrifying implication. A central bank that mobilizes its gold isn't just managing risk. It is preparing for a scenario so severe it cannot be acknowledged publicly. It is signaling, without speaking a word, that the stress has reached the deepest foundations of the financial system. The ultimate revelation, the one that underpins this entire hidden history of financial survival, is this: central banks don't swap their gold because they choose to. They swap it because the system, in its quiet, relentless logic, eventually forces them to. On the surface, a gold swap seems simple. A central bank temporarily exchanges its gold for cash, usually dollars or euros, but this isn't just a simple loan. This is one of the most complex, most secretive, and most revealing mechanisms in the entire monetary system. Understanding it exposes the true fragility of global liquidity far better than any official announcement ever could. To really get it, you have to stop thinking about gold as a sentimental relic or a symbolic anchor. You have to see it the way the system does, as the ultimate, final, unquestionable form of collateral in a world built entirely on confidence. Let's break down how this financial backdoor actually works. A gold swap has three basic parts: the transfer of a specific amount of gold, the receipt of a currency in return, and the contract to reverse the deal later. But the devil is in the details. The gold used isn't just any gold. It has to be good delivery. Gold bars that meet the super strict standards of the London Bullion Market Association for purity, weight, and quality. Only these perfect, standardized bars are good enough for a swap at this level. And where is this gold? It's not locked away in a vault in its home country. It's almost always already stored in one of the world's major financial hubs, like the vaults of the Bank of England in London, the Federal Reserve Bank of New York, or the Swiss National Bank. As of 2024, the Bank of England alone holds over 5,700 tons of gold for other central banks. That's nearly 1/5 of all the central bank gold on the planet. This isn't a coincidence. It's about logistics. If a central bank needs emergency cash, it can't afford to wait for gold to be flown across continents. That's slow, expensive, and attracts way too much attention. So, the swaps use gold that's already in the right place, ready to be mobilized instantly and discreetly. Now, here's where it gets even more interesting. When the swap happens, the ownership of the gold doesn't fully transfer like it would in a normal sale. It's more like a temporary pledge. The central bank lending the gold still counts it on its balance sheet, but it's recategorized as gold under swap. The bank receiving the gold gets the right to hold it and sometimes even use it for the duration of the agreement. This is where the transaction enters its shadow phase. You can actually see traces of this activity if you know where to look. The Bank for International Settlements, or BIS, often called the Central Bank for Central Banks, publishes data on this. For instance, the BIS reported that it intermediated gold swaps totaling 502 tons in 2022 and 354 tons in 2023. These numbers are way higher than they were in the early 2000s, when gold swaps were almost unheard of. This surge is one of the clearest signals we have that global liquidity stress is becoming more frequent and more severe. Why? Because the BIS usually gets involved when central banks want to conduct a swap discreetly, without revealing their identities to each other or tipping off the market that someone is in trouble. It's a transaction designed to happen in the shadows. The pricing of these swaps is another massive clue. A normal loan has a clear interest rate, but a gold swap is priced using something called the gold lease rate. This is a special rate, derived from the relationship between the spot price of gold, its future price, and the interest rates of the currency being borrowed. Historically, during major market stress like the dot-com bubble in 1999, the financial crisis of 2008, and the pandemic in 2020, these gold lease rates have turned sharply negative. What does a negative rate mean? It means institutions were literally willing to pay a premium just to get their hands on gold or to use it as collateral. A negative lease rate signals that the currency being swapped for the gold, usually the US dollar, is considered more scarce and more valuable at that moment than the gold itself. So when a central bank does a gold swap during these times, the pricing shows it's not a normal funding operation. It's an emergency. It reveals that the normal hierarchy of assets has broken down and the system is under extreme pressure. Gold swaps are the financial system's silent alarm. But the mechanism goes even deeper. Many of these swap agreements, especially those involving commercial bullion banks as intermediaries, contain something called a collateral substitution clause. This clause allows the party receiving the bullion bank, to reuse that same gold as collateral in its own separate deals. This is a process known as rehypothecation, and it's where the shadow system truly multiplies. Think about it. A single gold bar, officially owned by one central bank, can be pledged as collateral in a swap. The bullion bank that receives it can then lend it out or use it as collateral for its own borrowing. This creates chains of claims on the very same bar of gold. The BIS has pointed out that central bank gold from swaps and leases often flows into the wider gold lending market. Bullion banks might lend it to mining companies, ETF custodians, or other financial firms. Between 2010 and 2018, analysts estimate that average annual gold lending volumes were over 1,400 tons. That's a massive amount of gold, far too much to come from just private sources. Many experts believe that a significant portion of this volume originates from central bank gold that has entered the market through these discrete swaps and leases. Official confirmation is, of course, almost impossible to find. So let's put it all together. A central bank, facing a hidden liquidity crisis, quietly uses its gold stored in London to get dollars from a bullion bank. That bullion bank might then lend that same gold to a hedge fund. The central bank avoids a public panic, but its gold is now part of a complex, leveraged chain in the shadow banking system. The original gold is still on the central bank's books, but it's also somewhere else, being used for something else. It's in two places at once. This is the hidden world of gold swaps. It's a system born out of necessity, designed for discretion, and driven by the fundamental need for ultimate collateral in moments of crisis. It shows us that beneath the surface of our modern, digital financial system, the old rules still apply. When confidence evaporates and the usual lines of credit freeze up, the world's most powerful players turn back to the one asset that needs no one as promised to have value. They turn to gold, not as a symbol, but as a tool used in the shadows to keep the entire system from falling apart. When a central bank swaps its gold to get cash, that same gold can be used to support liquidity somewhere else in the financial system. Think of it like a library book. The library lends it to you, but they still count it as part of their collection. You might then lend it to a friend. Suddenly, one book is satisfying two people's need to read. Similarly, one pile of gold can be supporting multiple financial promises at once through chains of reuse. This dual function is why gold swaps have become so important, but it also introduces a hidden risk. What if too many institutions are all relying on the same physical gold? If a bank suddenly needs its gold back and tries to settle its claim, it could set off a domino effect. If the physical gold isn't there because it's been claimed by someone else, a liquidity crunch could spread through the system like wildfire. This is a real concern, especially when we look at the data. In London, where a huge amount of the world's gold is stored, the total physical holdings actually fell by about 1,000 tons between 2011 and 2023. At the same time, the use of gold swaps has been rising. Less physical gold, but more promises based on it. That's a recipe for increased fragility. Another fascinating aspect of gold swaps is their timing. Normal currency swaps, like the ones the U.S. Federal Reserve uses, often have standard timeframes like 7 days or 84 days. Gold swaps are way more flexible. They can be for just one night, a month, 3 months, or even over a year. This flexibility is crucial. It allows the central bank to tailor the swap to the exact timeline of the crisis they think they're refacing. So, when we see the terms of these swaps, we're getting a rare glimpse into what central banks are actually expecting, not just what they're publicly announcing. We've seen this happen historically. In 1991, the Bank of Italy used 148 tons of gold to secure a loan during a currency crisis. In the early 90s, Portugal repeatedly used its gold to defend its currency. These aren't just technical transactions. They happen when a country is facing serious economic pressure, like capital fleeing the country or speculators attacking its currency. The Bank for International Settlements, the BIS, is the key middleman in all of this. Why? Because the BIS has no political agenda. It doesn't have to answer to voters or deal with messy geopolitics. This makes it the perfect neutral party to handle transactions that central banks might not want to do directly with each other, especially during times of mistrust. Looking at the BIS's own annual reports, we can see a clear pattern. Gold swap activity was near zero in the early 2000s, but from 2016 to 2023, it was consistently above 300 tons a year. And the spikes in activity line up perfectly with major market stress events. The Chinese stock market turmoil in 2015, the Brexit shock in 2016, the global funding squeeze in 2020, and the chaos in 2022 when interest rates shot up. This isn't a coincidence. It's a structural reality. When confidence in the dollar system gets shaky, gold becomes the ultimate backstop. Now, let's talk about the most secretive part of all. Who is doing these swaps? We almost never know. The BIS doesn't name names. The central banks involved don't disclose who their counterparty is. This secrecy isn't a flaw. It's a feature. It's essential to the whole mechanism. If the market found out that a specific country's central bank was swapping gold for dollars, it would be seen as a huge sign of distress. This could trigger the very crisis the swap was meant to prevent. So the anonymity is what makes the tool work. It allows central banks to handle stress without causing a panic. But why would a central bank even need to do this? They turn to gold swaps when their normal tools stop working. Every central bank has reserves of foreign currencies, government bonds, and other liquid assets. But sometimes those aren't enough or can't be used. This could be because of sanctions, a freeze in the interbank lending market, or just a complete breakdown of trust between countries. During the euro crisis, for example, the Swiss National Bank's balance sheet swelled to incredible levels as it tried to manage its currency. While not officially confirmed, it's widely believed that gold swaps were part of their toolkit to manage the situation indirectly. For emerging markets, the case is even more straightforward. Think of India in 1991. They were in a severe economic crisis and had to physically ship 47 tons of gold to secure emergency loans. It was politically difficult, but it was one of the only options left when international markets refused to lend them money. Gold swaps are the modern, more sophisticated version of that desperate measure. So, what does all this tell us? A gold swap is not just a financial transaction. It's a psychological one. It reveals what a central bank is afraid to say out loud. It tells us what the market isn't supposed to know yet. And it exposes the real hierarchy of trust in the global financial system. When a country's regular reserves are not trusted, they turn to gold, the one asset that has no counterparty risk. When you see gold moving through these hidden channels, even just on paper, it's a sign that the system's ordinary tools are starting to fail. The gold swap isn't the beginning of the crisis, and it's not the end. It's the moment the crisis moves from the trading floors into the deep, quiet vaults of the global financial system. The most disturbing thing about gold swaps isn't the secrecy, or the quiet desperation that drives a central bank to use its most precious, untouchable asset. It's not even the fact that the same bar of gold could be backing multiple hidden deals at once. The real warning is what this mechanism implies about the world we live in right now. A gold swap is supposed to be a temporary fix, a bridge over a moment of intense stress, a silent agreement tucked away in the footnotes of a balance sheet. But every time it's used, even discreetly, it reveals a shocking truth. Our modern financial system, with all its complex derivatives, its high-speed electronic markets, and its multi-trillion-dollar balance sheets, ultimately falls back on the same ancient metal that held empires together when everything else started to crack. This should unsettle anyone who believes the global economy is more stable today than in the eras we read about in textbooks. Think about it. If the system were as resilient as policymakers insist, central banks wouldn't need to pledge their gold at all. The very existence of the swap tells you that somewhere, beneath the calm surface, pressure is building in ways the public is not allowed to see. And as the world becomes more fragmented and politically tense, gold swaps are likely to re-emerge. Not just as emergency tools, but as permanent features of a new financial landscape. A landscape where trust is a rare commodity and everyone is increasingly reliant on assets that can't be frozen, sanctioned, or questioned. When you see headlines about countries repositioning their gold reserves, the official story is always the same: diversification, prudence, strategy. We see Russia moving tons of gold into its own vaults. We see China increasing its reported holdings for 12 consecutive months. We see developing nations quietly reducing their exposure to U.S. Treasuries while adding bullion. But beneath that polite, sanitized language is a much more urgent reality. Central banks are preparing for a world where liquidity is political, where funding is conditional, and where access to the global dollar system can no longer be taken for granted. In that kind of world, gold isn't just a reserve asset stored away for a rainy day. It becomes an operating asset, a functional piece of the financial plumbing, a key that unlocks liquidity when every other door has been slammed shut. As more countries adopt this mindset, the gold swap transforms from a simple emergency measure into a structural signal. It signals a fundamental shift in the global financial order, moving away from systems built on trust and towards systems built on collateral. In a collateral-based world, the only assets that truly matter are the ones you can hold in your hand and move without asking for permission. The warning is quiet but unmistakable. If gold is being used more often, it's because confidence is eroding more quickly. And when confidence erodes, liquidity can evaporate in an instant. This creates a dangerous cycle where central banks must mobilize more and more of their reserves just to maintain a semblance of stability. For a while, the system can absorb this pressure. It can hide it with secret swaps, silent movements, and discreet backstops. But eventually, the pattern becomes visible to those who know where to look. You start to see it in the widening spreads between different currency markets. You see it in the fading appetite for long-term government bonds. You see it in the sudden thinning of market depth during what should be routine trading days. When that moment arrives, gold swaps will no longer be obscure signals hidden in financial reports. They will become the central axis around which liquidity crises rotate, revealing just how deeply the world underestimated its own fragility. So, what happens then? The answer isn't some dramatic Hollywood-style explosion. It's quiet. The system doesn't blow up. It just narrows. Funding becomes selective, available only to the most trusted players. Markets become brittle, easily broken. The hidden mechanisms that were once a last resort become the primary tools for survival. And the very institutions that once insisted they were insulated from stress will begin to reveal, through their actions rather than their words, that they are at the mercy of the same brutal liquidity cycles as everyone else. Gold won't save the system. It was never meant to. Its real purpose is to tell you when the system has run out of time. So when the vault doors move again, when the numbers in the footnotes shift, When the amount of gold under swap rises one more time, you'll know. You will know that the pressure beneath the surface has returned and that the world has entered another chapter it hoped would never be written. That's the nature of the backdoor. It stays hidden, out of sight and out of mind.